Ladies and gentlemen, good evening, good morning, good afternoon to all who have joined us today from across the world. I'm delighted to host this session, which I will believe very interesting and relevant and enriching to you all as you get into that stressful time of the year, tax season. This session is our endeavor to decode some of the pertinent tax aspects for you as we talk about tax pertaining to your income in India, be it from real estate, equities, funds, or deposits. I'm happy to introduce our speaker for today, Ms. Rupee Marwa, Partner, People Advisory Services at Ernst Young. She also co-leads Private Client Services Practice for E&Y India. She comes from a rich experience of about 18 years, having dealt in the areas of personal tax, payroll taxes, employee global mobility, trust structuring, and estate planning. She has authored many articles on tax issues for leading newspapers and journals and has been a speaker at various forums. While I'll hand over the stage or screen in this instance, I would like to inform you that the last 20 minutes of the session, we will put aside for question and answers. Please do not hesitate to put down your questions in the comment section of the YouTube, and we will answer as many as we can. Without further ado, I now invite Surabhi to share her insights.
Thank you so much, Deepthi, and welcome everyone. I'm very, very glad to be part of this session with you. I know it's going to be a monologue for the first 35 odd minutes, but you know, the way we framed it when Deepthi and I were talking, we put it as a lot of questions, we put it as a lot of simulations, so that real life experiences could come in, and we sort of premeditated some of your questions, but happy to have the last 20 minutes for questions. So please fire away. I'll try to answer all of them. Ones I can't answer, you may put in your email IDs, and both EY and HSBC will definitely be getting back to you on those as well. Without further ado, I'm going to move my slides. I hope you can hear me and see me. And okay, I'm trying to move my slide now. True consultant style, we have the disclaimer first, but I've quickly moved ahead. Deepthi, you started with, you know, that time of the year and taxes being very taxing. You know, I think it's throughout the year. They are taxing and they are taxes, and they you know, they hit your pocket and they hit your head. But then, you know, that's why you need consultants such as us. If there was, you know, if life was too simple, then, you know, we won't be needed. So with a joke, I think the taxman is also kind to us in that sense. So what I'm going to take today is, you know, when we were curating these slides, you know, we were talking about it, thinking about what is it that you as non-resident Indians would like to hear. And I immediately, you know, the HSBC and EY team said, what is it that NRIs really look at? What is it that they invest in India? Because, you know, India is very much the emerging market. And even if you've been outside the country for many, many years, you know, your roots are still left to India. And I took cue from my own brother and sister, both NRIs, one in Australia, one in the United States. And you know, a lot of the slides that I made was also keeping in view personal life or real life examples. So it's as real as it can get. Of course, quantums change with everybody, but I think the buckets of investment remain the same. So here, you know, nowhere in these slides am I going to be talking about what's the you know, the right mix of investments, or you know, what is it that you should have as a debt equity ratio. I mean, you all know that, and you know, HSBC is guiding you on that. But it's really to say that when you are looking at investment decisions, look at the wealth part of it, but please look at the tax part of it, one, at the time of investing, and two, at the time of liquidating those investments. Because remember, tax rates right from 10 to 42 to 37%, 39% can go a long way in reducing those gains. So that's a very important part. So with that, I'm going to start with, I think, something which is very interesting to all Indians, resident and non-residents, which is mutual fund. I'm not going to be talking about what mutual funds are. If you are on this webinar, if you're an HSBC customer, I'm pretty much sure that you must be dabbling in them in various degrees of in dollars and pounds, etc. But there are basically two types of you know, mutual funds. One is equity oriented, and then there's debt, or I'd call them other than equity. Why something called equity and debt depends upon where their underlying investments are. So typically, if 65% or more of the fund's investments are in equity, it's called equity oriented, and vice versa. And of course, returns vary with respect to whether it's equity, debt, hybrid, etc., and so on and so forth. But first, when you're making any investments, you've got to know, is it debt or equity? That's the first thing you need to know. Number two, of course, after you've seen the returns and compared the NAVs and gone through, you know, with your wealth manager about the pros and cons that suit you, what is the important thing you need to keep, you know, remember in your head with respect to tax? 12 months is the key number you need to remember for mutual funds that are equity oriented. Anything that you hold for over 12 months becomes long-term capital gain. And why is it so important to be long-term? Because capital gains in excess of, you know, for mutual funds held for more than 12 months are taxed only at 10%. And there's this little 1 lakh rupees or 100,000 rupees, that's an exemption. We keep that aside. But the underlying tax rate is 10%. Of course, there will be surcharge and cess depending on your income level, but it's 10%. If you hold them for 12 months or less, which is because they become short term, then immediately your base capital gain rate jumps to 15%. So the next time you're looking at saying somebody telling you get out of this equity oriented fund, etc., and you've got 11 months invested in that, you may still get out of it, but think through, I'm paying 5% extra base tax. Does it make sense for me to stick on for another month or so? Otherwise, you know, maybe I lose the tax advantage. Of course, 10%, 15% are only the base rates. We have this one little thing on our head called surcharge, which is 10% if your income is between 5 million to 10 million, and 15% if it's over 10 million. This is a fixed rate for non-residents. So very important to know this. 12 months is the key month, ladies and gentlemen. If your mutual funds are other than equity oriented, which we normally call debt, now this 12-month period doesn't apply. It shifts from 12 to 36 months. So immediately 3 times over. Why 36 months? Because typically debt is supposed to be long term, but it's very much in the act. So I'm not getting into the nuances of why the taxman said 12 months for equity and 36 for debt. But for debt, if it's listed, it's 20% with indexation. Indexation means you adjust it for the cost of living. So if the cost was 100 10 years ago or 5 years ago, then the cost can become 120 or 130. But if it's an unlisted debt fund, it's 10% without indexation. So very important to know this. If you hold it for 36 months or less, it's not 15% like in equity, it's slab rates. And remember, our slab rates are 30% plus surcharge plus cess. So they go up to 39%, they go up to 42.7%. So be very careful before you liquidate any of your debt-oriented funds before 3 years, because the tax rates can change massively. So that is very, very important for you to know. Depending upon your income level, like I said, surcharge up to 37% is levied, which can take the slab rates up to a very, very high level. There is something in that little yellow box which says that grandfathering for cost of acquisition. I tell you to ignore it for just 1 second so that nobody gets confused, but I will take that up as an example as we go along in the slides. And if you still need more data or details about it, then you can post questions in the chat box, of course. So what we tried to do here is we said, let's look at real life examples. You know, a lot of theory can get very boring and people sort of lose interest. And today everything's about quickness and technology and apps and numbers. And, you know, I've got a 20-year-old, so I understand, you know, where they come from. But let's look at some examples. So and I'm talking about you all here, we purchase equity-oriented mutual funds. Remember the box on the left that I spoke about right now? We purchased them on the 1st of January, 2019. They were worth 1 million. So how do I compute capital gains if I sell them, say, on 3 different dates? The first time I sold them for 1.05 million on the 1st of April, 2020. Now, if you see this from 1st January 2019 to 1st April 2020 is more than 12 months. So situation 1 is there will be no capital gains. You've held it for more than 12 months, so it becomes long term. When it becomes long term, remember that 100,000 rupee, is exempt for a long term capital gain. So how do I compute capital gains here? I sold it for 1.05 minus 1 million is which is my cost, and because it's 0.05 million, there is no capital gains because 100,000 rupees or 0.01 million is exempt from tax. So in situation 1, ladies and gentlemen, no tax for you. We move to situation 2. You have the same sale, but you sold it on the 1st of November 2019. 1 year or 12 months haven't lapsed. So let's go to bullet number situation 2. Here you will have capital gains because you sold it for less than 1 year, and that 100,000 rupee delta or exemption that you got in situation 1 is not available to you. It's only available if you hold the shares or the mutual funds for over 12 months. So remember that as well. 12 months and the 100,000 rupees. So the capital gains here are 1.05, what you sold it for, 1 million, what you bought it for. And there is going to be a 15% tax rate. So if you remember the box on the left, we said short-term capital gains for equity-oriented, 15%. You have this surcharge, which is the 115, which is 15%. And then the education cess that we have in India, 4%. So effectively, on these gains, you've paid 17.94. So if you had kept it for another couple of months, you would have paid 0 capital gains tax. But now, because you sold it, maybe you were getting a lot of gain, but maybe you didn't know about taxation and you hadn't consulted us, but then you're paying gain of 17.94. Situation 3 is again when you keep it for a year, so you know about, I'm assuming this in this situation, you know about the capital gain. Here the capital gain will be there because you sold it for 1.2 million minus the 1 million, which was the cost. Remember, we bought it for a million. I always get an exemption of 100,000 rupees, which is 0.1, which is exempt from tax. So your gains are 0.012 million, and the tax you pay is 10%. Of course, you have the surcharge, which is the same 115, which is 15%, and the cess. So the minute you kept it, even if there was a massive gain to be made, the minute you kept it for over 12 months, the tax rate effectively moved from 17.94 effectively to 11.96. So such is the beauty of knowing what your tax treatment is and keeping it for a little longer. Of course, if the gains or the market was worth selling it earlier, it's a call you take. But my reason or our reason for letting you know is that your calls to redeem any mutual funds take into account this tax situation. Let me move on to my second example, which is shares. Now, who doesn't dabble in shares in India? I do. I think, and we've seen the excitement of the markets in India. I mean, I don't think you have it in any other part of the world. And if you are of Indian origin, which you all are as NRIs, you know that little bit of play in the Indian markets is something you have to do, and that's where the gains are to be made. So listed shares in India, the same 12 months like equity-oriented mutual funds. Capital gains, again, that 100,000 limit which was there in mutual fund applies, 10% without indexation. Indexation I spoke about is to adjust the cost of living. If you keep it for short term, which is 12 months or less, it's 15%. And we have the same rates of surcharge that I spoke about. So I'm sorry to say, but the surcharge remains 10% and 15% depending upon your category of income. Unlisted shares, and if you know how complicated, you will tell me should be kabhi 12 months, and then you said 36 months for debt oriented mutual funds, and now you have a new one which says 24 months. Unfortunately, that's the way the cookie crumbles, and that's why tax is taxing. But unlisted shares in India, the important period to know is 24 months and not 36 and not 12. The taxation is 10% without indexation. And here, if you hold it for less than 24, which becomes short-term capital gains, again, the draconian slab rates, I shouldn't call them draconian, but yes, it's much further away from a 10 or a 15% if you look at the left side, or even 10% as you look if you hold it for a long term. So very important to know that if you've kept these shares for less than 24 months and they're unlisted in India, your tax rate could go up to the highest slab rate, which is very, very high in India. So keep that in mind. I've got that little annoying yellow box here, annoying for you because I'm not talking about it, but I will in a moment. What is this box that, you know, on our slides about grandfathering, and why is it important? And I'm going to take it by an example. Why this box is important? Because about 2-3 years ago, when one sold listed shares in India, there was no capital gain. So that's the reason people used to buy listed shares, because there used to be no capital gain when you sold them. Then the budget, in a couple of years ago, brought in taxation of capital gains. And because the budget was announced in February, which is pretty much, you know, towards the fag end of our fiscal year, they introduced something called grandfathering of costs. Because remember, all along the year, you were buying listed shares thinking they were going to be tax-free, and suddenly tax was introduced. So how would you protect some of your gain? So this is where grandfathering came in. Now, I'll explain that as in an example. I think it's best explained in an example because otherwise it can be a bit confusing, not a bit, but quite a bit. But I'll try and, make it as simple as possible. So this taxpayer, which is you, me, anybody, has acquired equity shares of an entity which is not listed. So this is unlisted shares on the 1st of January, 2018. The shares are worth 1 million. And how do I compute capital gains? I sold it for 1.3 on 1st of April 2020, and then I sold it, the second situation, 1.3 on 1st November 2019. Now, situation one, very simple. I've got a long-term gain. It's more than, you've seen more than 2 years. And this is unlisted, so 2 years matter, not the 12 months. It was the right side box, so 2 years. Here it's, the capital gain will be 1.3 minus the one that I sold it for. And my effective rate is 13%. Now remember, you'll suddenly ask me, what happened to that 100,000 of exemption you were talking about somewhere in those complex boxes? This is unlisted. And unlisted means unlisted in India. Even if it's listed anywhere in the world, it's unlisted for India. So that 100,000 rupee, minus that I was showing in the other examples is not available. But because in situation one, you paid capital, you've had a 2-year period, you're paying a tax rate of 10% plus the surcharge. So it's effective rate of 13%. In the second case, because you held it for less than 2 years, between January 2018 and November 19, you can see that the tax rate just jumps to 39% because the base rate, if you see that little asterisk on the bottom, is 30% plus the surcharge. So again, very important for you to know, unlisted, hold it for 24 months. Of course, if the market situation seems right, because your tax rate has suddenly quadrupled, it's gone up 3 times. So that's, the reason we set out these examples, even though the amounts were small, and we set out these examples and we gave this effective rate, was because when you see these things, or, in practice or through examples, the difference, or the stark difference of how tax moves within just a few months comes out. And sometimes it's much more effective if you show it like this rather than just talk about it. So that was really the purpose of explaining it through these examples. My other example, and this one is going to be a little interesting, is for a listed share. And a lot of us dabble in these listed ones. And I'll move this around because two very fine nuances are going to come in. So I bought these shares for 1st of January 2018, 1 million. I sold them for 1.3 million on 1st April 2020. Now remember, for listed shares, it's 12 months. So it's a long-term gain. Now in situation one, my capital gains tax, 1.3 million. My cost is 1 million. However, because I bought them before 1st February 2018, something called grandfathering was available to me. And this grandfathering is only available if you bought these shares before 1st of February 2018. The grandfathering says, and it's a very complicated formula, but pretty much you can substitute the fair market value of the shares acquired instead of the cost. So basically your cost increases because the cost, you could have bought it at 10, but as on 31st January, and when the rules change, if the fair market value was higher and you can therefore reduce your capital gains, the law allowed you to do so. And I've given you the reason about a minute back. So for this gentleman or this lady, the capital gains tax is not 1.3 minus the cost of 1 million. It is 1.3 minus the substituted cost, which is the grandfathering, which is that annoying little yellow line that was coming in my slides. So instead of 1 million in my situation one, I do 1.3 minus 1.2. And then the other beauty of a listed share is that 100,000 rupee exemption that we were speaking about, and I'm calling it exemption, in tax terms, there are other names, but just for simplicity, the 1 lakh rupees, which is not taxable, is also deducted. So for this taxpayer, it's 1.3 minus 1.2 minus the 0.1. And the effective tax rate is 10% because it's long term, and then the surcharge and the cess. So it's coming to 11.36. In situation two, the gains are short term. Now, if you see here, it's not only the tax rates that's changing in situation two. Number one, the grandfathering that I gave in situation one, where I substituted 1 million for 1.2, is not available. Want to point this out twice, and I'm sorry for maybe replaying the same thing, but important for you to know, the minute it became short term, you did not get the advantage of substituting the fair market value. So to that extent, obviously your gain is higher. And the second thing you couldn't do is you didn't get that minus 0.1, which is at 100,000, which is only available for long term. And the third thing is that your 10% rate changes to 15%. So therefore, for listed shares, between long term and short term, it's not only the rate differential of 10 and 15%, it is also that you don't get grandfathering of the cost of acquisition, which here is a small amount, but in reality could be a massive amount. So the cost in situation 2 was 1, while in situation 1 was 1.2. And then you also didn't get the 1 lakh rupee. Maybe that's a smaller amount. That's important for you to know. So that's shares for you. Again, you've seen here that the effective tax rate went up massively, not really as massive as in the first illustration I spoke about for unlisted, but it has gone up by a lot. And, depending upon the gain amount, these 5-6% could be, could be a very, very significant amount. And, even if it's not a very significant amount, this is tax saving that is very bona fide and something you should do and something that you should at least be aware of, which is the purpose of this joint EY HSBC webinar today, or this webinar where we are coming in as knowledge partners. Now, dividend income. Now, we talked about mutual funds, we talked about shares. What happens when you have mutual funds and shares? When you sell them, you make capital gain, and I spoke about it a lot in the last few slides. But you also earn something called a dividend income. About 2 years back, dividend income was tax-free from Indian equities and mutual funds. And the companies who distributed the dividend had to pay DDT, or dividend distribution tax. 2 years ago, it was about 2 years ago, and I'm sorry if I'm forgetting exactly, how many months back, but about 2 years ago, it was changed to taxing income in the hands of the individuals. And there were several reasons, because the way the dividend income taxation in India worked it changed 3-4 times from individual to corporate and back to individual and corporate, but pretty much they did it because world over it was easier for individuals to say it's taxed in their hands, because around the world that's the way it was done. So tax credits, if you guys are filing tax returns in other countries, become easier. So what is a dividend? How is it being taxed? Dividend from equity shares, tax is 20%, and then you have the surcharge that I spoke about and the cess. Dividend from equity-oriented mutual funds is also 20%, and then you have again surcharge and cess. So 20%, and this is not taxed at slab rates. This is a specific rate given because for NRIs specifically. So this is something of a lot of importance to you, that it's not at slab rates but at fixed rates. Why I have this box on the right side called treaty? This is specifically because all of you being non-residents means that you're non-residents of India under the Income Tax Act, but you would likely be residents of another country. If you have a lot of dividend income, my tip to you or my suggestion to you would be, look at where you are a resident of the country, because India has a network of treaties with almost all countries. And if you are a resident of another country, then under the treaty that India has with that country, for example, with Japan, with Singapore, UK, Australia, you can be taxed at a rate much lower than 20% plus surcharges. This rate could be 25, 26, 22%, but you could be taxed at a flat rate, for example, if you are a resident of Japan at 10%, if you're a resident of Australia at 15%, because the treaty that has been signed between, say, India and Australia, and I'm partial maybe to Australia because I have a sister there, but that's why I'm picking up the example, but because the tax rate or the dividend rate in the treaty is 15% flat. So why do you need to know this? Why do you need to talk to your advisors about this? Because why should you pay dividend at 20% plus surcharge and cess? When you are a resident of, say, Australia, you are able to get something called a tax residency certificate from the government there and get a beneficial tax rate. You have to do a little bit of form filing for it, but it's not complicated. It's something that has been very clearly laid out, formats, and you can actually get a lower rate for dividend taxation. I'm giving this to you as a bona fide tax planning, tax saving tip, because this is something that is set out very clearly under our Act and Treaty, and people who are advised correctly are applying for these forms and taking this preferential dividend treaty rate. So very, very easy to do if you are a resident of another country, which I'm assuming most of you would be, since you're NRIs of India. So just wanted to point this out to you. Another, I think, instrument where we saw people really interested in was non-convertible debentures. You get interest income from non-convertible debentures. It's taxed as income from other sources. And there are some, in case you have special provisions or you apply special provisions for NRIs, which is you all, a flat tax rate of 20% applies. And I'll talk about some of those provisions in a little later. But this 20% applies if you do not take any deductions and exemptions. For example, there are exemptions if you make some investments, etc. But if you don't take those, then a flat 20% rate applies. Again, like I talked about the dividend, the special rate under the treaty, it's not so much for interest income, but depending upon the country you are in, it's very important to see the treaty and see if there is a possibility of getting a preferential rate. So that's something I'm leaving open. It's a little complicated and depends upon your situation, but keep it in mind so that you can look at it before you file your tax return. Now, the other thing you get from NCDs, one is the interest income, the box on the left, is if you sell it. So gains when you have a secondary sale in the market. I'm assuming for my example that this NCD is listed in India. Otherwise, there are lots of these bonds, masala bonds, 5%, 15%, then it becomes a bit, bit more complex. But capital gains have to be paid. So I'm just taking an example, assuming it's listed in India. If you hold it for more than 12 months, it becomes long term. So 12, 24, 36, back to 12. It's 10% without indexation plus the surcharge and cess. And if you keep it for less than 12 months, then again, those, massive slab rates can come in. So very important to know this again, because non-convertible debentures are often traded, and there's, whenever we get these offers from anybody in the market, we look at whether it's primary or secondary, and therefore you should know about this 10% rate, or if the holding is less than 12 months. I also wanted to say that if you have fixed deposits, I don't have it on the slide here, but if you have fixed deposits with the banks, that's also interest income. So pretty much it's taxed like this interest income is taxed. It's taxed on ordinary slab rate. So there is no specific rate. Like in NCDs, there's a 20%, but for interest income from your bank FDs, it's taxed at normal rates. Just wanted to let you know that. Now, this is an interesting one, because I've seen very few NRIs that don't have immovable property in India. Either they have it because of inheritance, or they have it because, they studied here, so they invested, or because I think the Indian middle class still has this love for immovable property and real estate, especially in the north of India. But I think a lot of NRIs do too, to hold on to maybe ties in India. I'm going to talk about 2-3 very, very important points here, and I hope they resonate with you, and you take them back with you as well. First line is very simple. What is capital gain when you sell a house property or an immovable property? It's the sale price minus the cost of acquisition. Any expenses that you incur on account of transfer are allowed as a deduction. So that's number one. The period for immovable property is again 24 months. It used to be 3 years a few years ago, but it changed to 24 months a couple of years back. So any property that you hold for more than 24 months becomes long-term. Now, what is the beauty of long-term here? We spoke about long-term and listed and the advantages. A lot of advantages for long-term in immovable property as well. Number one, you have this indexation benefit. Remember, I spoke about indexation in the past, saying your cost of acquisition is adjusted as to today's cost of living. So 100 could become 180. So imagine, $80 of gain gone. Your tax rate is 20% plus the surcharge and cess. There is something called a rollover exemption. So if you sell one house property and you buy another one within a certain period of time, and there's lots of conditions, there is no capital gain. Even if there is capital gain, it's exempt. Or if you invest that money in, say, bonds, etc., there's a lot of sections in the Act, you could actually save capital gain. So if you are not selling this property to take the money outside where you live, and you just want to reinvest, or maybe because your children want to come back, or you want to keep ties to India but you want to buy a smaller or a bigger asset or something, and then please know, and that's what I want to leave you with, that if you've held it for more than 24 months, it's long term, and you can reinvest it, and your capital gains can effectively become zero. But the reinvestment has to be within a certain period of before buying, before the sale or after the sale. And if you reinvest it, then you can't sell that new property for a little period of time. I don't want to complicate it, but the point is to tell you that it's available and there's some conditions attached to it. Now, one very important one that you should know: when you're selling your property, let's assume you sell it, the buyer of the property is required to withhold tax. So the government, many years ago said, maybe people don't report gains, so the buyer will do a little TDS, and therefore it will get reported. And then if the seller is not reporting the gains in the tax return, the income tax authorities get data from the back end to see, so you sold something to Deepti, and Deepti did a tax withholding against your PAN number, but you haven't reported it in your tax return. So therefore that means, oh, I'm sorry, I forgot about it, or whatever it is. But that's how the whole transaction works, or as they say, the taxman will know more about you than you know yourself. So that's how the tax deduction works. But for non-residents, what we've seen, and this is very, very practical advice that we've seen, is that the buyer will normally withhold tax at the total sale price. So assuming it's 100, he'll withhold tax on the 100. While your gain could just be 20, because one, you have no other income. Two, let's assume it was long term, you got a 20% tax rate. Maybe you held it for 20 years, so your cost of, your cost really went up. So instead of 100, which was the amount of sale price, the gains could just be 10. But the buyer has withheld tax of 20 or 30% at 100. And when you're going to file your tax return, you would probably see a huge refund. So what a lot of people come to us and tell us is that, you know, how can you help us? So what we say is, if you're planning to sell your property, and you know that the buyer is going to withhold at 100 while your gain is 0 or 10, then there's something called applying for a lower withholding tax certificate in India. So how we do that is we calculate the gain, and then we go to the income tax authorities and say our gain is only 5 or 10, while our my sale proceeds are 100. So please give me a certificate where I can tell the buyer that he has to withhold tax not at 20 or 30%, but at 5% or 4%, so that I don't have a refund in my tax return and I don't have to chase for that refund. And there is no cash outflow to me. More than that, there's no cash outflow, because the buyer should have only withheld on 10 rupees and not 100. So that's something we often do. We either, you know, we go to the authorities and obtain this low withholding tax certificate. Of course, you know, there's a lot of complication in the law for it, but we've seen practically in innumerable cases that the buyer wants to be safe, and he'll say, look, till you don't give me a certificate from the from the tax authorities, I'm going to withhold tax on your gross consideration and not on the gain, and you can go and take a refund from the authorities. It's not my problem. So if you're planning to sell, you can, and you know, and we can do anybody can do the calculation for you. Taking this low withholding tax certificate, especially for larger properties which have been held for a long time, where gains are expected to be very less, is a short way of saving your outflow of tax. So I'm going to just explain this very quickly in an example. I'm just seeing the time. I've got about 5 minutes to go. So this taxpayer inherited a residential house from his parents in 2021, very typical of India, where we have inheritance and, you know, where parents still want to pass on their properties, etc., to children. The house was acquired by the parents in 1995, many years ago, for 2 million. Now, the taxpayer sells this house in December 2021 for 12 million. Now, it's very clearly it's long-term capital gain. The rule says that if it's a long-term gain, then you can, instead of the cost, you can take the fair market value as on 1st of April 2001. But like what I explained, grandfathering in the shares, but this is not called grandfathering. This is just the way the law is, that if you bought it before 2001, then you can take the fair market value as on 2001 as the cost. Now, of course, you'll have to get that valuation done or figure it out, but it could be a massive difference. So it's definitely worth it. So here it's, if you look at the yellow bullets, it's a long-term capital gain. The cost of acquisition here, even though the parents have bought it for 2 million, we are going to take the cost as on 1st April 2001, which is 3.5 million. Now, the beauty is it's long term. So this 3.5 million is also indexed. So we look at 3.5 million was the cost in 2001. So what is the cost in 2021? So if I use the cost of living index, and these are published, so you don't have to worry about where I'll get it from. So if you inflate it for the cost of living index, 3.5, if you look at bullet number 3, becomes 11.1. So imagine, had you done 3.5, your gain would have been massive, but the law allows you to do 12.11.1, so your capital gain is 0.9. So that's how you pay the tax, 20.8%. Now the buyer, let's assume Dipsurbi is selling to Deepti. Sorry, Deepti, I'm putting you on a spot here. But Deepti has to now withhold taxes, because that's the law, because that's what she's supposed to do. Now, Deepti actually, you know, if I don't give Deepti a lower withholding tax certificate, she'll say, Surbi, I'm withholding tax on 12 million. While I'll say, but my gain is only 0.9. There's a lot of difference between 0.9 and 12. But the way to avoid it is that I should go and get a low withholding tax certificate, or at least a CA certificate, so that Deepti, as a honest taxpayer and as someone who wants to do compliance, is comfortable doing the withholding only on 0.9 and not on 12, because otherwise Deepti doesn't know. You know, that I have a 0.9, I've got to give her some proof, and only a calculation doesn't work. It has to be backed up by either a certificate from the government, from the taxman, or a CA certificate. But what's more important, I think, what works foolproof is the certificate from the tax authorities, which is called a nil or a reduced withholding tax certificate. So just a little comparison here, you know, again, just wanted to say, let's assume you as NRIs invested in equity shares or equity mutual funds or debt funds or NCDs or real estate. If your initial investment was 10 lakh rupees in each of them, you held them for 4 years. I've kept everything the same. 10 years, 10 lakhs, 4 rupees. 1 million, 4 rupees, 15 lakhs, which is, the same in three. The tax on capital gains based on, and based on all of the things we spoke about in the last 25, 26 minutes comes out to the line number 4. And the effective rate of tax moves from 11.96 in equity shares or equity oriented mutual funds to 26% in real estate, depending on various circumstances. So, this is not set in stone. It depends upon a large number of factors, but we wanted to put it there together for you, because you should know that because of the period of holding, because of the tax rates, because of the various exemptions given both to non-residents and residents, because of this whole beauty of indexation, grandfathering, fair market value as on 2001, how the tax rates can really change. Just wanted to also spend maybe a minute on this and a minute on my last slide on the special provisions for NRIs. These are optional provisions you can take if you invest in convertible foreign currency, and a lot of you do so. So we just wanted to point this out. And if you invest in foreign currency, in shares in an Indian company or debentures or deposits in a listed company, then you have to pay a flat rate of long-term capital gains at 10%. And on any other income that you get out of it, which is non-capital gains, it's 20%. Now, if you look at, the box number 2, the last bullet, and I should have maybe made it bold, but I want to draw your attention to this. If your income as an NRI is only investment income or capital gains, and full taxes have been deducted by the payers on these capital gains and on this investment income, then you don't need to file a tax return in India. So just be very careful about this. Typically, full taxes are not withheld. So even if someone tells you, boss, you have only investment income or capital gains, and therefore my understanding is you don't need to file a tax return in India as an NRI, I would say, well, partly true, but you also have to see whether full taxes have been deducted, because if you have a tax payable and you don't file, that's a compliance error, and you can get into trouble with the taxman. The exemption part is what I spoke about, is the rollover provisions. In some of these, when you sell them, you can reinvest and nullify your capital gains. Just wanted to leave that with you as well. I think my last slide before I hand this over to Deepti, and I think I've got just about a minute to go. It's said in the world today that the taxpayer will know more about you than you know yourself. And I think India has done a brilliant job in this annual information system and the TIS, which is the new system, where all the data of any purchases you make, any taxes that you pay, any rentals that you get, etc., is now available with the taxpayer on the portal. So it's called a taxpayers information summary. It's something very new. It's just come in, and it has all your information about any taxes you pay. And if you look at my 4th little bullet, it says, savings, credit card transactions, stock market. So, imagine if the taxpayer has all of this information and you haven't filed a tax return, or you haven't disclosed all of this in the tax return, you could just be faced with a big notice. So I think important to know how your investments work. Download this something called Form 26AS. It's available on the income tax portal, and see whether you need to file a tax return. If you do, it's easy to file a tax return. Otherwise, you have a lot of consultants, but also look at whether you can take any treaty benefit, like I spoke about, especially for dividend income, and so that you're always on the right side of the law, but you also save taxes by doing the right thing. That was my last slide. I'm going to hand this over back to you, Deepti, for any questions, and happy to take as many as you shoot at me.
Thank you, Rupee. That was quite insightful. And there are many questions coming your way. I think let's spend as much time as possible and answer as many as we can. So the first question, Surabhi, is how are gains earned from mutual funds taxed when invested through SIP, which is systematic investment plan, and when I transfer through a systematic transfer plan?
Okay, so when you transfer into a systematic investment plan, there is no taxation at that time because you are only doing the SIP. You are only investing at the moment. When you redeem your SIP, so whether you put it in one go into a mutual fund or whether you do it through a SIP, which is month on month or 15 days, there is no tax when you're putting in the money. The tax incidence only comes in once, one, when you're receiving the dividend, which is what I told you, and two, when you redeem the plan. So example, you put in 6 SIPs. So from say July to December, I put in 6 SIPs in any mutual fund. Nothing is being taxed when I'm putting the SIPs. Now I come to say it's 3rd of December and I want to redeem this mutual fund. When I go to my app or when I go directly to the system, it will tell me how much do you want to redeem. And I'll say all units or 10 units or 20. And then I have to see what is the sale price of those 10 units and what is the price that I invested in. And therefore, based on everything that I spoke to you, apply the tax rate depending upon short term, because I did it in 6 months, it's obviously short term. So nothing when you do a SIP, to your question.
Yeah, thanks. Thank you, Surabhi. So if a customer had invested through SIP, at the time of sale, it's treated almost on par with equity mutual fund or a debt mutual fund.
Yes.
The second question is, actually, these are two questions. One is, what are unlisted shares? Part one of the question. And the second part is, if I have capital gains from sale of such shares, which is below the basic exemption limit, do I still have to pay tax? So I'll expand this, maybe the second part, Surabhi. Can you also just give your view, whether it be a listed share or an unlisted share, would the tax filing and tax paying is applicable when the overall amount is less than the exemption limit?
So, number one, what is an unlisted share? An unlisted share is a share which is not listed on any stock exchange in India. That's what it is. Even if it's listed in any other part of the world, for the purpose of tax treatment or for the purpose of the period that we gave 12, 24, etc., and the tax rate, it is considered an unlisted share. So very important for you to know. Two, to your question, if your income from any source, which is listed capital gains, unlisted capital gains, dividend, salary, etc., whatever be it, if it's less than the basic taxable limit in India, you don't need to file tax returns because you're an NRI. And I'm going to just complicate it a little bit more in case you have residents who are relatives. The only time you have to file tax returns is if you have a resident, and even if you have zero income, if you have foreign assets, then you still, with zero income also, you have to file a tax return. Plus there are some other nuances which or some other factors that came into play in the last budget, that if you have an electricity bill of this much, if you have a foreign travel, etc., then you have to file a tax return. But to the best of my understanding, that only pertain to residents. But I'll recheck if that also pertain to non-residents. But that's really what the answer is. So what I owe whoever asked this question is, if those, because there were 8 or 12 conditions that came in, that even if you have zero income, do you still have to file a tax return? To I think it was for residents, but I'll come back and check if it also, if there is any one line that also pertains to non-residents, even if they have zero income.
Thank you, Surabhi. The next question is, what's the rate in India, US and UK DTAA for dividend?
UK is 10%. The India US from what is a little bit more complex. There is no flat rate per se. So for whoever has this question on the US, I will request you to write to us because we'll have to get a little bit more understanding of your situation. But UK, it's 10%.
Okay. And how does double taxation between India and UK work? And if I pay tax in India and in UK, then where should I claim back, and what happens if tax rate in UK is higher than India? And how does the treaty save taxes?
Okay, so this is we're gonna have to extend our session by another hour for this one. So how does a treaty normally work? You have to be a non-resident in one country and a resident in one. Sometimes you're a resident in both countries, so we make you a treaty resident in one. So let's not get complicated. So let's assume you're a resident of the UK and a non-resident of India. What I do is I look at all your incomes, each one of them. It's not a general thing because each income has a different methodology under the treaty. Typically, let's assume you are a non-resident of India, resident of the UK, and it's Indian sourced income. Indian sourced means, for example, rent from your property in India, dividends in India, salary in India. Let's forget salary for a moment, but let's take supposing rent and dividend. Now, India says you may be a non-resident, but this is sourced to India because it is from an Indian source. The shares are in India, the properties in India. So India has the first right to tax, which is understood. UK accepts it. The second part is what is the rate of tax that will apply? Like I said, there is no special rate for the rent, but there is a special rate for the dividend, which you'll have to apply for through the form 10F and etc. So let's assume you applied for that special rate and you paid tax on rent in India as per the Indian tax rules. Now you're a resident in the UK. The UK will say you're a worldwide. I'm assuming you're a worldwide resident there. So I want to tax all of your India income. India and UK, by the way, classic example, very similar in tax laws, because we kind of inherited it from them many years ago. So UK will say, now Dipti, I want to tax. Dipti, I'm taxing you everywhere. Sorry, don't shoot me there. So, but let's say UK says, Dipti, I've got to tax your Indian rental and I've got to tax your Indian dividend. But UK will take into account the fact that you've paid say 30%. So let's assume it's 100 rupees of rent. After certain exemptions and benefits, it becomes 50 in India because India allows you certain deductions. Let's assume UK also allows you certain deductions and it becomes 60 in the UK. So UK will see what is the doubly taxed income, which is 50. They will take into account the tax that you've already paid in India and deduct it and then ask you to pay further tax. Now, if the tax rate in India is already higher than the UK, obviously you don't have any tax to pay in the UK, which sadly today is the case. It's 42.78 for certain incomes. So that's how the treaty works. I'm not getting into the reverse situation because this is a webinar primarily for NRIs. So therefore, I've curated my answer for an NRI, but that's how it will work. There is no, I can't even think of a country where we don't have a treaty. Some African countries we don't, but typically this is the way it will work. You will look at, where are you a resident? You will get a TRC. You will look at the treaty. You will look at every category of income, because every category of income has to be seen separately. Like I gave the classic example of rent is different and dividend is different. So that's how you should follow it.
Thank you, Surabhi, and I absolutely don't mind. As long as there is an income, I'm willing to pay the tax. So please take my example freely. Another question that came up is, on redeeming SIPs, is the cost on a first in, first out, or on an average?
Again, a tricky question there. Typically, they will give you an average cost. If you are redeeming all of them together, then the question doesn't come, because they will take because you're doing it all together. But if you're doing it on a unit basis, then yes, they will. Then the first in, first out basis makes more sense. So depending upon this, you will have to take a full statement and then compute the capital gains.
Understood. Thank you. Another one is, what is the taxation law for UK residents exercising ESOP in India?
Okay.
Do I need to pay tax at two places, and how to claim one and where?
Okay, this again is, and maybe this person will have to come back to us. ESOP income is taxed in a very special manner in India, and I'm assuming you got this ESOP when you were an employee in India or you are an expat working in India. ESOPs work like this: no tax when you've got the ESOP, no tax when it's vested. So since you asked me the question on ESOP, obviously you know how it works, but for the benefit of everybody, you get the ESOPs, the options, then they vest you. Vesting means that there were certain conditions attached. Those conditions are over. No tax in stage 1, no tax in stage 2. Stage 3, when you exercise the ESOPs, that is, you pay the exercise price and you become a shareholder, that is the time you get taxed. And if you got these ESOPs because you are a salary earner, because that's how ESOPs normally are given, because you got them as employment, then you have to pay something called salary tax, which is, right, it can be 42.7%. But how we also use taxation in India is that you look at the period between grant and vest. Only the India serve, and if you're a non-resident, which you are, then I will say what is the period between grant and vest? 1 year. But if you worked in India only for 6 months out of this 1 year, then India will only tax the proportionate income for the 6 months, which is the methodology we follow. It's not set out in the law anywhere, but that's the commonly used methodology. UK will need to see. Sorry, I think someone is on mute. Is unmuted. UK will need to follow their own system of taxation of ESOPs, but to the best of my understanding, and I'm not a UK tax expert, they will also tax only the UK period unless you are globally taxed resident in UK. Even if you are globally taxed resident in UK, they should take into account the tax that you paid into India and take a deduction for it, like I spoke about. But if you want to talk a little bit more about this, and because I don't want to take the next 10 minutes because you know a lot of questions. If you want to talk a little bit more about it, please feel free to write to me and we can have a discussion.
Great, Surabhi. Another question is, can you please elaborate a bit on the double taxation treaty with UK and give an example of how it can affect the sale of property in India? And does it matter if the investment is through NRE or NRS?
Very quickly, I have a lot of UK residents here, as I can see. Let's assume for a moment that you sold the property and you did the capital gains properly, and you know the long term, etc. How can it affect? First, you need to go. India will tax the capital gain for sure. Let's assume you haven't reinvested, etc. Because again, like I spoke in the first example, it is India source. So even if you spend 0 days in India, it's an Indian property, and therefore India source. So India will tax capital gains. You have to go, therefore, you have to go to your UK tax advisor and tell him that it's Indian source capital gains. The UK advisor will look at the India-UK treaty. We will see where you are becoming a resident. I'm assuming you're becoming a resident in the UK, and therefore apply the treaty to see whether the UK should not tax it at all. So depending upon your residential status in the UK will either say, okay, you know, I'm not going to tax it at all, which is not likely to be the case, but UK will say, okay, there's capital gain. You've paid tax at 20% already in India. If the UK rate is say 22%, I'll ask you to pay only 22 minus 20. Or if the tax rate in UK says 18% because of your situation, then nothing for you to pay in the UK. But the important thing is, because you're an NRI, remember that example I took of 12 million and 0.09 where I was selling to Deepthi. You know, that's very important to you, because whoever is your buyer, you please ask him what rate are you deducting tax, and can I get you my capital gains statement and a CA certificate or a lower tax withholding certificate, so that you withhold at a lower rate as well. Because what's the point of paying higher tax in India and then fighting for a refund or a tax credit? Because UK will not give you a tax credit if you've applied for a refund from the tax authorities. They'll only give you a credit for the amount you actually owe to the authorities. So that's the nuance
there. Right. So another follow-up question is, can an NRI himself pay the immovable property capital gains tax by obtaining the CA certificate, as buyer is not willing to take the responsibility?
Yeah, so you know, the payment of the tax is your responsibility only. What happens is, for example, your sale consideration was 100, but gain was 10. Now you have to pay tax on the 10. Now, if the buyer has withheld tax of 20% on 100, which is 20 rupees, while your tax is only 2. When you file your tax return, you will say tax payable to, tax already deducted 20. So there'll be a refund of 18. What we're trying to say is you can avoid this refund of 18 by getting the CA certificate, so that your buyer, instead of doing 20% of 100, does maybe just for 2 rupees. So that 18, which becomes a cash flow issue to you, gets reduced. Otherwise, you have to still pay the tax yourself and show it in your tax return.
Yeah, and one very common question, Surabhi, is how does, and especially in this globally mobile scenario, what happens is people keep changing between resident and non-resident status, right? So how does an individual's residential status change from non-resident to resident after returning to India?
So India has something called tax rules, which are based on physical presence. Our rules are not based on passport, except in one situation, which came in 2 years ago, specifically for the Middle East expats. So how do the rules change? We have something called a physical presence test. I don't know how much detail to go into, but there are 3 types of tests. There's a 60-day test, there's a 182-day and a 120-day test, and then a 29-day test. So typically, when you're coming to India, first see, are you in India for more than 60 days in the current year and more than 365 in the last 4 years? If you are, or if you are more than 182 days in the year that you're talking about, you become a resident of India. Then you have to elaborate it further and say, am I a resident which is only taxable on Indian income, or am I a full-blown resident, for which you need to see the last 7 years. Also, there's something called deemed residency, where if you are an Indian passport holder and you're not a resident of any other country or not paying tax in any other country, you're always a resident of India. This changed 2 years ago, and if any of you attended our last webinar or are reading the papers, you would have known kya ho gaya Dubai, what is happening there. That's called deemed residency. So I see Deepthi also nodding. So couple of points, it's based on day count, so you can talk to us and we'll have to do your specific determination. And two, if you are an Indian passport holder still and you're especially in the Middle East, you need to come back to us on something called deemed residency. I can't elaborate further. I know Deepthi has more questions and we've got only 2 minutes to go. So pardon me for that, but we'll need to talk a bit more.
How is NRE fixed deposit interest taxed? And what is the rate under domestic tax law and Portugal treaty?
The beauty of NRE is that if you're a non-resident in India, for tax and even for exchange control. So first of all of you should know that the definition of non-resident for tax and exchange control laws is very different. Most people I talk to don't know this. You may be a non-resident for tax, you could be a resident for exchange control. Let me take an assumption that you all live outside. You haven't come to India for employment, etc. So you are a non-resident even for exchange control. NRE interest for a person who is a non-resident for exchange control purposes is exempt from tax in India. So that's why people love putting money in NRE accounts. So, but just do that determination of tax residency versus residency for something called FEMA or exchange control.
Yes. Another one is if a non-resident Indian is residing in a foreign country and they do not pay any tax, such as somebody residing on a retirement visa. So how does this then, the treaties apply to them?
There is no special provision for you, sir or ma'am, unfortunately. You worked very hard, golden years, but the taxman still comes. There's no age limit for paying taxes and filing in India. So all of the provisions I spoke about are agnostic of age. There is a little difference in tax rates when you're a senior citizen, but it's pennies and pounds, so not very much, nothing changes. The treaty provisions also have nothing to do with age. So they are explained about going into every category of income, where are you a resident and all, as very important. Remember, the treaty comes into play, and especially if you're retired and you're probably in different countries, maybe the treaties come into play only if you're a resident of one country. If you're a non-resident of each country, like you're spending 3 months in UK, 3 months in Thailand, etc., then these beneficial tax rates of dividend, etc., don't come into being. So that's all I can tell you. But you'll have to do the determination just like even a non-retired person.
Okay. Another question is, any additional tax payable in UK on dividend income earned in India on which taxes have been deducted at 10%?
It depends upon your tax rate in the UK and also depends upon your filing status in the UK, because UK, like India, has several filing status: non-resident, non-ordinary resident, etc. So assuming that you are taxable in the UK on worldwide income, we'll have to see the tax rate applicable for you. But if it's more than 10%, then yes, you'll have to pay the delta. So that, I want to reiterate, this question is coming up again and again, but it depends upon several factors. One is UK taxing you on India income, which depends upon your status in the UK. Two is what is your effective tax rate there, which depends on a lot of things, because UK has a lot of laws domiciled in UK, non-domiciled. You can take if you take a non-domiciliary status, you can do it for 7 years, and therefore your overall global income is not taxed. So for UK, it's very important to take specific advice, because I don't want to go wrong and I don't want you to go wrong either.
Yeah. So I know we're on the top of the hour, Rupee, but I've got one very interesting question.
Sure.
So I'm going to extend it by a minute.
Sure.
If you can answer this. How does DTA work when there are different tax years? Like India follows a financial April to March and US is a calendar Jan to December.
So, in the last budget, there was specific mention that they would do something about this, and especially, for 401k income, etc., which is, and those of you in the US would know it, but no rules have come out as yet. What we do practically is, so we look at, supposing I'm doing April to March in India, and I have to look at double taxation elimination. I will take your tax returns in the US for both years, 2020 and 2021, and I'll try my very best to break out the income between 9 and 10 months, 9 and 3 months, and be able to match it and take the foreign tax credit. There is no other way to do it as of now. So the government has not said yet that because US has a calendar year and you have a fiscal year, just ignore it or just take the 2020 US return, because when audits come, and remember audits have become faceless now, they want to see, they practically asked us, compare it with the US return. So we've done this comparison. First 3 months, this US return, last 9 months, this US return, and we've tried our very best to get the income from the taxpayer to say that instead of prorating 9 into 12 and 3 into 12, let us see what you've earned every month. So it's very complicating, but that's the way the cookie crumbles. We have to do that mechanical exercise.
Yeah, tax is complicated. Yes, Surabhi, and that's the reason why we have experts such as you to decomplicate it and let us know how we can best use the rules and save some tax if possible. But one common theme and comment that has been coming up is, can we share this presentation? So for all our viewers, please do reach out to your respective RNs or the branch managers, and we will help you out as much as we can. And thank you, Surabhi. It's been a great session, very insightful, very informative. Thank you for taking time. And for all our viewers who've joined in, thank you. We hope you've gotten some great insights. And as you keep planning to make a visit back home, we look forward to welcoming you. Thank you all.
Thank you, and stay safe. Thank you, Deepti, and thank you to the HSBC team, and thank you to Aditya Modani from my team and Uday. Thank you.
Thank you.